Welcome everyone. Thanks for joining our panel on how to raise money for your co-living project. We're really fortunate to be gathered here today to learn from 4 founders and co-living executives who have raised large amounts of capital for their co-living companies. Before we jump in, I just kind of want to say that we only have about 45 minutes allotted to discuss this topic that we could easily spend hours dissecting. So in order to get the most value of our discussion, I'm going to be kind of rigid with how we progress through this. So I apologize in advance if I cut you off to move forward. We're going to leave about 10 to 15 minutes for the audience to ask questions. So folks in the audience, please send your questions over the chat throughout the panel, and we'll take notes of them and ask our panel at the end. Now let's get to the introductions of our panelists and our moderators. Everyone's going to have about 60 seconds to introduce themselves, and that's just a hard line 60 seconds because we don't have too much time. Please just say your name, your company, the company that you're with, your title, what interests you the most about co-living right now, and if you have time, where's your favorite place to travel to? And I'll start off, and then we can pass it to Alex, our other moderator, and then we'll move to the panelists. So my name is Frantz. I'm the founder of Bounce Co-Living. We're based in great rural locations in the United States. I'm also the lead North American ambassador for Co-Liv. One thing that really interests me most about co-living right now is the subscription-based living. And when I like to travel, I really love to go off the beaten path and find places that aren't too developed yet. Alex, can you introduce yourself?
Sure, thank you. Welcome everybody. Thank you for our host and our guest today. My name is Alex. I'm currently in Italy. We are a co-working operator, about 8 years, and with a strong background in technology, especially in IoT, Internet of Things, and migrating into co-living and co-working as an operator. Why co-living? I am a millennial inside. My burb and white hair doesn't, let's say that I'm not a millennial at all, but I try to understand and to live personally the new social changes and after COVID challenges that we have. I will ask Luca Bovone, to be here with us and to give and for free your experience. Could you please introduce yourself?
Sure, thanks a lot, Alex. Thank you, Frank. I'm very happy to be here. So my name is Luca Bovone. I'm the founder and CEO of Habit. Habit is a co-living player based in Europe. We started in Berlin around 4 years ago. We now operating around 4,000 units over 13 different cities and 5 countries. Among the different countries, we have Germany, Spain, Netherlands, Portugal, and Italy. And my favorite place to be is Madrid. As you can see, my shutters are down because there's too much light where I'm in the moment. So which is Madrid. So very happy to be here. And I pass it back to you guys for the next intro.
Okay, Amaury, could you please introduce yourself?
Sure. Hi, everyone. Thanks, Coliv, for having me here. Very pleased to be here. My name is Amaury Courbon. I'm one of the co-founder of Colonies, which is a French operator of co-living. We now operate some hundreds units and developing thousands in Europe. I'm in charge of development and operation at Colonies. And well, I would love to be at the very moment in a place where I could have a lunch at a terrace. So anywhere but France.
Thank you very much. This is positivity. And then Ritu, please, your turn.
Absolutely. I'm Ritu Jain. Hello, everybody. I'm the co-founder and CPO of LifeX. We started in Copenhagen, and we are in 6 cities in Europe at the moment. In terms of, I think, where I would love to be, I am close to my heart is being in the mountains. So if I'm not working, and so I think you'll find me hidden somewhere in the mountains. But
Cool. I think Frank could have an open invite for you. Frank.
Let's
I
go
can see
skiing
that
together.
head shaking, which is awesome.
Fantastic. And last but not least, Mo, please, your turn.
Thanks, Alex. Thanks, Frank. Really excited to be here. Hello, everyone. I'm a co-founder and chief investment officer at Star City. We've been around since early 2016, just over 5 years. We're a co-living developer and operator in the United States and Spain. The most exciting thing about co-living for me right now is the transition of the asset class into one that's really 24/7 versus a place that used to be an evening hub for folks. So that transition is really interesting. That's been sort of initiated by the pandemic. Favorite place to travel is Costa Brava in Spain. So every time I'm in our Barcelona office, I love heading up to Caliv, which is a small town up in Costa Brava.
Wow, we are perfectly in time. Sorry to stress on this, Frank. Tell this, we have a really short time, but we are sure that we can do a fantastic job today. So Frank, please, can you give our overview why we are here today?
Yeah. So thanks, guys, for those introductions. Just want to kind of preface before we jump into the questions, like why we're here and why this panel is so important. And I think it's just because of how relatively small the co-living industry is globally and the rate it's growing. And I just want to give some stats, from some various reports that kind of show how small the industry is and why this might apply to a lot of folks in the industry. So I pulled these numbers from Cushman & Wakefield reports, Co-Living Insights, and the House Monk. In the United States, there are about 8.5 to 10.5 co-living beds, while there are 110 operators. Most of these beds are operated by a handful of companies. In Europe, there's about 13,000 beds amongst 250 operators. And so if you crunch the numbers on these, you're seeing that there's a lot of very small operators that are probably looking to grow in the future, which will require capital. And so having you all here who have raised large amounts of capital is super important to these folks. And we're seeing co-living grow at a crazy rate compared to the traditional rental market. I think in the last 5 years in the US, the rental market grew at about 0.2% annually, while in the last 7 years, the co-living industry has grown over 8,000% here in the US, from 100 beds to over 8,000. So I just think that's important to note, because I think we do have a lot of small operators on the call today. And then one other thing to note before we jump in is when we talk about raising money for co-living, we're really talking about two different things. And I think that's really important to separate. We're talking about raising money for the operations side, maybe paying community managers, marketing, sales, and other business expenses, versus raising money for a real estate deal or purchasing a building or furniture, that sort of thing. And the returns and the investor profile and the risk level, the capital required are all significantly different. And so today, when you're answering your questions, please just be sure to clarify what exactly you're talking about. But without further ado, let's jump into the questions. So Alex, will you take us away?
Absolutely. Luca, please, your first question is for you. So what you see within the co-living industry, we realize that there is a lot of entrepreneurs that don't have a real estate background like you, if you can confirm, but see the potential for co-living and have started their own co-living. So what is a great way to start from not having any information or experience in real estate? How do you approach investor, this beast, without credibility or strong network within real estate? Please.
Yeah, thanks, Alex. Well, yes, I can confirm. I don't have any real estate experience prior to starting Habit 4 years ago. It was definitely tough to enter into this market, and I think that it was very difficult to convince the first investors. I think overall convincing investors to invest in the equity part of an asset light operator is extremely complicated for obvious reasons. It's a very tiny margin business. It's very difficult, very operational. So only a few crazy investors will invest in this kind of model. And I think that most importantly, you need to have a very strong narrative and a very strong vision, something particular that is only about you and that is very specific, that will add and create a lot of value in the future. I don't necessarily think that is among all things that one could start at the moment. It's probably very tough to start an asset light operator and raise money for it right now, especially if you don't have prior real estate experience. Obviously, if you come with a background with lots of assets because you have a specific family office or investor behind you, then that could be a little bit easier because you can have that kind of narrative to start off. But otherwise, I think it would be pretty complicated. I think everybody here on the call has their own sort of angle. We all have different kind of business models as well. And so I think everybody's trying to kind of like cut their little corner also with investors in order to raise capital. So I think having this narrative is the most important thing for us. We are one of the few players that sort of has started and stayed fully asset light, and we want to continue on this path. So not taking any sort of risk on the asset side. I know that, for example, Star City here, has a different model. Same with Colonies, or some sort of in between the asset light and the asset heavy model. So I think it would be super interesting to maybe hear from them as well. What is their angle, and how do they see the fundraising part?
Fantastic. Just a question. In 4 years, do you see investors changing, approaching with, let's say, easier the co-living industry, or they are always tough?
I think, if anything, the investing, equity investing market for asset light operators is just gotten tougher. And the reason is that there have been multiple events like the WeWork, let's say, debacle, and for example, COVID, of course, impacting everybody's occupancy numbers that have made the market even tougher. And then, of course, with the consolidation happening in the market and a few bigger players emerging, including ourselves, then it just gets tougher and tougher for other players to raise equity. And when it comes to
that started at 4 a.m. Oh my
God. Sorry, guys, could you mute your microphone, please? Thank you. Okay.
Yeah.
Please.
So no, I was saying that it's just gotten a little bit tougher, and with all these events, as well as the consolidation and a few bigger players emerging, including ourselves. But at the same time, with the size, so as you grow size, you enter into a different kind of class, and the bigger the size of the company, of course, then it also gets easier. But overall, as a sort of from a top-down perspective of the market, I would say that the market has actually gotten tougher to raise equity for this kind of model versus 4 years ago.
Fantastic. Thank you, Luca. Very interesting point you start with. Frank, your turn.
Yeah, and would be interested to hear from the other folks on the panel if you have anything to add to these questions. They're not just specifically for one person, so feel free to jump on.
I'd like to add one point. I think Luca's absolutely right that it's getting harder to raise equity for the operator side of the business. You've got large players in each major geography. You've got consolidation in the industry. You've got headwinds like COVID. But I do think it's actually getting easier to raise capital for the real estate side of this business, because you're seeing successful comps. You're seeing refinances. You'll soon see major exits in the marketplace, and so the real hard assets are getting easier to raise capital for, in my opinion.
Cool, thank you. Other point from the other two speakers?
Well, I do agree with you, Mo. It's way easier to have real estate money today, because like 4 years ago, when we're talking about Coliving, nobody knew about it actually. And now, as of today, you can talk with big real estate players with a low profile of risk. You know, in insurance, for instance, are now investing in France in co-living industry. So the yield, as we saw it, went down by 100 to 200 bips. So it's completely crazy to see how co-living is seen in the market today compared to what it was like 4 years ago. So yes, it's way easier to have real estate money, but it should be harder to have equity money. So I totally agree with you guys.
Okay, so there is a good news. You guys help the market open. They, you know, like the height, you break the highs some years ago. So for the people hearing today, the good news is, I don't know, is easier like other markets, other industry, but for sure, compared to the past, something changed. Ritu, do you want to add something?
No, I think, you know, Luca, I think he said it well. You know, yes, I think there is real estate funds here. And yes, equity investments have gotten a little tougher, but I think that will definitely change, right? Because this is also a long-term game, right? So I think, you know, co-living is not something that's, you know, I think one thing is that, yes, we've had challenges with WeWork and we've had challenges with co-working, but we can all see that the fundamentals of the models work, right, long term. And I think that's the base of it. So I think it's really about, you know, how well you can scale your company, how well you can run your operations, how well you can look at your margins, and then opening up opportunities based on that. So.
Very good, very good.
Great, thank you. All right, we'll head to the next question, and this one's actually for Amaury and Ritu. What are the 3 most important things you need to demonstrate to investors when you're raising capital for your co-living venture? And I guess before you answer, maybe just specify on if you're asset light or asset heavy for the audience who might not know.
Yeah, absolutely. I can start first, if that's okay. So I think in the definition of, I guess, co-living, we are actually asset-light model as well. But I think even asset-light comes with its own labels, right? You have, you know, leasing and you have management agreements. So there are different types of asset-lights too. So I think there is also another, change in some ways. We are moving more from leasing to more management agreement as a model. And for LifeX, we actually work with some of the large institutional real estate players now, and we are working on projects that are around co-living, but more family style co-living. That's the biggest, difference that we have. And I guess if you talk about investors and, you know, what is most important to bring to the table, if you ask me 3 things, I think one of the things I had already mentioned, and I think Luca alluded to that a bit more, is that this is a very different industry. I come from, you know, technology world where you see very different type of economics and financials. This is very much about how efficient can you be, and how can you leverage technology in an industry that hasn't necessarily seen that for quite a few years, right? So I think, and leverage technology not just for creating new services, etc., but also to make your model even more efficient. So I think, you know, definitely how efficient you are is probably one of the biggest things that you look at. I think it's also interesting. I think more and more investors are now thinking about how sustainable can you be, right? Even without investment. So how profitable are you, right? As a model. And I think all of that goes back to how efficient you are. So I think that would be the first thing. The second thing that's connected to it, and at least that has played in our advantage, is technology side of things. I mean, even now as we go and, you know, talk about what we do at LifeX, I think people are quite surprised in terms of how its technology has been part of our DNA from the beginning, and where we actually deploy technology and how efficient our model has been able to be because of it, right? So I think that's something that puts us apart a little bit. And then I think a third one is definitely you know, the scale that you can achieve, and the story that and your brand that you are creating, right? And I think that is very, very important, because you can of course be a co-living provider where, you know, you have building as an asset, you provide co-living services and do the operations, but if you don't have a strong brand around it, then it actually can't help you scale. And I think that is really, really essential. And I think that's something that, you know, is it comes with the quality of service, the quality of product, what your members or your tenants, however you describe them, what they talk about you, how do your landlords, your institutional real estate partners, what they think about you, all of it comes from that. So I think those are 3 elements: is efficiency, technology, and your brand, basically, I think. Yeah.
Wow, those are some really great insights, Ritu. Thank you. Amaury, do you have anything you'd like to add to that?
Sure. Well, I think as an asset light operator as well, very close to Ritu business model, I would say besides all of that, that you need to prove your ability to scale fast and efficiently. And this may be, in my opinion, the biggest challenge, because scale is a long way ahead and you have to build strong foundation to be able to scale. In terms of relation within your networks, do you have the proper real estate investors? Do you have the proper developers to do business? Can you do quick and beautiful and efficient? Quick is a word difficult to hear from real estate developers. So you need to deal with that as well. And this challenge took us like 2 to 3 years actually to pave the way to grow. It's absolutely crazy how difficult it is, especially in a bear market, if I could say that, like 4 years ago when we were talking about Coliving and nobody knew about it. So if you show that to someone, you will be interested in what you have to say, depending on your product. So I think if you have that, and in addition, a strong brand, a huge narrative on this is co-living market, this is where we can go, and I think we can achieve up to X thousand units, then you will be able to raise a lot of money from VC investors, especially. So I would add that on top of what you said, right?
Thanks.
Sorry,
Alex, would you like to say?
Yes, there is Leah. Sorry, guys. I would like to mute. Leah, could you mute? Okay, thank you very much. Yes. So third question, it's for Mo. I mean, starting from Mo. So what is the type of investor? Outside, there is a lot of investor, even in the assets class, in the real estate asset class, especially what personally have a feedback about WeWork. WeWork did try to deal with the technology company going fast, exactly Amaury explained to us. They do very fast, but the result it was bad. So is there a way of business model that could be evolved from WeWork, or what did WeWork, or not? Or is the same way, but with a new energy and new products? Mo.
Sure, happy to answer that. So I think, business model is absolutely crucial to scaling. One of the things that we believe WeWork was doing wrong was sort of the long-term obligation, the master lease model, where they didn't have downside protection. So I think if you're going to use the master lease model, or just any leasing model in general, you have to really look at the legal structures, and you have to negotiate for downside protection, whether that's through mark-to-market clauses, recession mark-to-market clauses, or whether that's through just generally favorable terms on what you have to pay as your base rent, so that you're sort of arbitrage between what you pay to the landlord and what you ultimately will net after your expenses. is healthy, right? And I think that WeWork sort of struggled with that. They of course had other issues, but I do believe that a leasing model could be successful with the right investors behind you and with the right structuring on the deal side. We at Star City moved away from the leasing model very early on. We did it for our first couple of deals back in 2016, but we just discovered that long-term, that wasn't how we wanted to create value, and our investors were a bit more patient, luckily. And so we focused very much on the management side, on the operator side of our business, both management contracts as well as revenue share models where we're not taking on long-term obligations onto our balance sheet, and making either fees from managing third-party client properties or sharing in both the upside and the downside. And then on the developer side, we entered that side of the business because ultimately it allows for a stronger balance sheet. It allows us to not only generate revenue from design and development of co-living, but it also allows us to long-term leverage against our assets and bring down our cost of capital. As you'll know, in real estate, cost of capital is a major concern for folks, and so the ability to have an asset base to leverage against has been super helpful for us in getting creative in how we grow. So to me, it's not that WeWork was just doing things incorrectly, and I don't think you can just easily write off the leasing model. It can work. It just needs to be structured appropriately.
Cool. Thank you for your point. Other guests would like to add something? Maybe.
Well, I actually had a follow-up to that. So their business model obviously wasn't the greatest, and they saw the downsides when COVID hit. But some also argue that like taking tons of VC money and fueling their rapid expansion hurt them the most, which kind of leads me to my next question about what type of investors you look for when you raise money, and kind of talk about, as a vertically integrated company, do you look for real estate investors for your developments and then VC dollars for your operations, and how do you go about that process?
Sure. Yeah, great question. Yeah, I mean, so for some context, Star City's raised approximately sort of $50 million on the operator side, and then we've raised over $100 million on the sort of property company real estate development side. On the operator side, we did start with venture capital, right? That was our first go-to place because we thought we were going to be building this sort of rocket ship that was going to be scaling really, really quickly. But once we discovered that the only way to grow really quickly on the sort of asset-light model was to use, at least at the time back in 2016 and 17, to use the master lease model, we decided to sort of shift strategy. And so ever since then, we've been focused on the operator side on family office capital. Family office capital is a source of capital, especially here in the United States, that there's plenty of, and it tends to be more patient than venture capital money, right? It doesn't have sort of a life cycle on their fund by which you need to exit, right? With VCs, you have to exit the investment for them, usually 10 years or less, right? And so in real estate, as we know, things are pretty slow to move. So unless you have an exit strategy that's less than 10 years, venture capital is probably not the right source of capital for you. So we've shifted to, family offices who've got real estate exposure, who may want to invest in our real estate projects, but want simultaneously to participate in the upside of the brand and the technology-enabled operations, and just the presence in multiple markets as we scale. On the real estate side, in addition to sort of family offices, we have approached institutional sort of private equity, everyone from sort of notable global private equity players for larger developments to smaller private equity shops who may just be real estate focused on a regional level. I think it really depends on the size of the asset you're trying to build. If you're trying to build small co-living, there's an investor for that. If you're trying to build mid-size co-living, there's a different investor for that. And if you're trying to build large scale, that's a totally different investor. What you need to identify is where is the sort of match between the building you're trying to build on the real estate side and the investor sort of appetite, right?
Wow, thank you, Mo. Those are really great insights. I'm interested to hear from some of the other panelists that have also raised money, and it seems like we have a lot of asset light operators. So would be interested to hear like your experiences raising money.
Sure. I mean, I can go also touching back a little bit on the WeWork thing. I think there has been a lot of confusion, I think, around the whole WeWork debacle, and I think that it's very important for everybody, especially us that are in a kind of similar industry, to also give some clarity about what happened. And I think that now with WeWork basically going public, that is like the narrative is shifting a little bit again. And I think that the biggest issue there was probably like a mismanagement issue and mostly an overhead issue, and the sort of scaling that they did and the money that they took on, just like you said, it was more like hurting rather than benefiting. And in the end, they basically overvalued the business, right? And I think that that's like valuation is probably like the most important point for co-living operators to raise money, right? Because at the end of the day, this might just be a business where an investor can do like a 5x or a 10x, even 15x, 20x, but it might just not do the 20 to 100x than that the pure technology company might do, right? And I think that the issue with WeWork was just in that classification. So the company was probably fairly healthy company on the sort of unit economic level, at least on a good scale to create some cash flows, but has had a massive overhead that was driven by the fact that they were marketing themselves to investors as a full technology company on full technology multiples, therefore raising a lot of money and sort of perpetrating this issue of massive overhead costs and so on. And so that really sort of built up this paper castle that in the end fell and hurt the whole industry. But the fundamentals of the model, just for the co-working as much as for the co-living, are healthy. And it's just about hitting and striking the right balance with the right investors, seeking the right multiples and returns on their investment. So I think along the line with what Mo said, I think that more like maybe private equities or sort of family offices might have a similar expectation on return on investment for what concerns the operating the co-living model, and so I think that should be the target. I mean, we are having fairly good success raising capital among these group of folks. So I think that that's kind of like the way to go. So I think it's really about the characterization, of the industry and making sure, that you are characterizing it well, you're pricing it well in your multiples, and then I think that the rest will sort of go well. So that's, I think, the biggest issue that was kind of like this unclarity over the past, 2 years that caused this. Yeah.
Thank you, Luca. Ritu, would you like to add something to this point, please?
I completely agree with Luca in terms of, how this has been viewed and how, what type of investors have worked even for us. I mean, I think the additional thing, if I had to add something, is, more than patience is one, right? So it's not necessarily about scale at all cost anymore. It's actually efficient and smart scaling. And when I say smart scaling, it's also about taking on the right deals that don't necessarily hurt the unit economics long term, or not taking unreasonable terms where you're locked in for too long. And some of these things that, that some of these companies like WeWork, and I think we haven't really talked about that as much, and on co-living side was quarters as an example, had to do, right, in some ways. So I think that those are lessons that we can learn from. But I think along with the patient side, the second one is also bringing on investors that think about, compliance and regulatory side of things in this industry. I think, like you said, Frank, that co-living is still quite young. And I think, we can learn from some other industries like Uber and Airbnb and think about what are the things we can do right, in the sense that what can we do differently, how we work with the cities, how do we take on regulatory or challenges and compliance challenges. And I think that actually also plays a big role. I think we have been quite happy about the investors we have, because they actually did want us to make sure that we have a very solid foundation to scale from. And so I guess you become a little bit more of a trusted partner when you know that you are taking the cities and the city's needs into consideration. So it's not just managing like real estate partners as stakeholders, or not just managing your members or your tenants, but also managing the cities and their expectation and their goals for the next 20, 30 years. So I think it requires a different type of investor to think about it on a holistic perspective, and not just about who brings in the money, basically. So.
Great, thank you. And I think we have about 2 more questions and maybe like 8 minutes before we go to the audience. And so the next question that we're going to ask is, what are like the main objections for when investors turn you down for money? Like, what are their main hesitations and arguments whenever they decide not to invest? And I know that's always the hardest part. So I'm really interested to hear what you guys have to say about this.
Well, I think it depends. I think it really depends on which investor you're going after. On the operator side, I mean, the objections tend to be around scale. Can you scale this? Is this going to scale quickly enough? If you're approaching the VC investor. If you're approaching a more patient investor, right, it's about how is your brand going to stand out and differentiate itself amongst the competition. There's now significant competition in the space, unlike 5-6 years ago. So how are you going to be different? What's your sort of unique value proposition to both the consumer and to the real estate owner or landlord? On the property side, on the real estate development side, it's about placemaking, location. What's the hold period? What's the exit? Is there actually a premium that you can achieve on your square foot or your square meter as opposed to traditional multifamily? So you're answering a totally separate set of questions based on what you're raising capital for.
Okay, Amaury, please. I saw you before. Want to say something?
Yeah, sure. Well, on the real estate side, things have changed a lot as well. We're still talking about location and product, and what are the guarantees you can offer to an investor. And this is a topic we didn't address so far, but this is a huge one, especially for asset-light operators. And this is, well, actually, Coliving is quite a big brand, especially in France and in Europe. And we still have some complexity about that is completely crazy. You need to have a lot of money blocked in an account to make sure that you're able to sign the lease, or at least be able to enter into development. And this is, I think, one of the biggest questions you will face during your development is how to deal with that, how to raise money from VC investor, private investors that are willing a huge return on it, and block this on a developer bank account and wait for your development to be finalized, or wait for your lease to be finalized to get this money back. So this is something you have to find solution about. And many things can be done with insurances, with bank deals or anyway, but it will cost you a lot of time and sadly a lot of money. But this is a way you have to go through, and once you get big, then you will find solution. So I think that if you want to be sure that a real estate investor will listen to you, make sure you big enough, or make sure you have enough money in your bank account at minimum to show him.
Okay, I would like to jump on the last question with something a recap about relationship with with marriage, let's say, between two different guys. And so except for the hospitality investor, the hospitality, they know that a hotel is not a matter of just real estate. General real estate investor, general VC, can cope with the idea of real estate and services. So how you, in your experience, try to, to find and to find, let's say, a relationship with these guys they even don't know what a service real estate is. Luca, would you like to explain, please?
I said I didn't really understand the question. So if
sorry, the point is real estate is traditional, co-living is really innovating. So how you can match two different mentality when you talk with the investor?
Yeah, no, definitely. I mean, I think it's always been, especially when we started 4 years ago, it was definitely difficult to explain what we are, right? Are you a hospitality operator? Are you a property manager of residential real estate? And slowly with good and bad news coming out, and also actually thank to an organization like yours, we are kind of like entering into the conversation, as an industry and making a dent. And I think that as Mo and Amaury said about raising funds for the real estate side, that's because the real estate investors are starting to getting to know the asset class and are starting to slowly dedicate more and more of their asset allocation to this new segment that we call co-living. I think that this is the challenge. I think it's an education perspective. I think it's about defining who we are, and I think that every one of us panelists at this table today is doing something to basically refine this messaging, right, with sort of providing services to the owner, the propco and opco model, an asset light product like ours at a very large scale. So I think as everybody go on their own route with their own angle, and as more and more events like this will happen, the real estate investors will get used to this kind of co-living segment, and we will basically define it as we go. And to be honest, I think not even ourselves, I didn't know really what I was doing when I started. I think pretty much everybody here as well, if I had to guess. And I think that's pretty much where we are now. It's it's getting better, it's getting more defined, and I think over the next 4 years we will have an even better understanding of what we're doing, and the owner in that respect will also have that understanding as well.
Thank you for endorsement on coliv, Luca. Completely free. We don't we don't plan that. And Mo, could you give your point about that, please?
Yeah, absolutely. So I think you have to sort of showcase, ideally with data, if you have some data from existing properties, but if you don't, work with other operators. There's plenty of us now to showcase data that the premium that you can achieve on a revenue per square foot or square meter in co-living will offset the slightly additional cost of co-living, right? So I think if you can showcase that and show that your operating expense ratios, your margins are still healthy, then real estate investors will get it, right? They ultimately care a lot about the numbers. In addition to that, I think how you present co-living to institutional or real estate investors is really important. When they hear co-living, they might have a gut reaction that, oh, that's tied to co-working, or, is that co-housing from the 1960s, like my parents lived in or I lived in? So you need to sort of describe this in the best way possible. For us, what's been successful is, 21st century workforce housing, or affordable by design micro living, right? Or multifamily with higher density apartments, depending on the city, geography, and investor we're talking to. So just wanted to make that point.
Thank you very much. Ritu, would you like to add your point, please?
I mean, I think what I would add is, I think this is true with any type of fundraising, right? Is that you will hear a lot of no's. And I think not to get discouraged when you hear a lot of no's, because I think it is true when you're building something new, and even though co-living is a lot more defined now, I think there's still a lot of questions. I remember when we first started fundraising, it was more about what people want to share bathrooms, right? We had to go past that to talk to some of these investors that didn't understand this, because especially on the real estate side, right? It's a very different type of thinking around housing and living that was very detached from what was happening in the millennial world in some ways. So I think you will hear a lot of no's, and that's completely okay. I think what you do want to find are people that really believe in your vision and your mission and your brand and what you're trying to achieve. And I think it will happen, right? I think you actually, one thing, you know, people don't think about is that it's as much you interviewing the investors as much as they are interviewing you, because it is a marriage, it's a long-term relationship, and they'll be with you from the
Definitely. Definitely, that is a marriage. Exactly, that relationship, very strong, very strict. Amaury, please, could you in 30 seconds give, I'm so sorry, your last question, to the point?
Yeah, maybe from another point of view, I would say that look for the right investors, meaning that you may have the chance to know which investors are now interested into co-living. And when I'm talking about co-living, I'm talking about housing. And something is happening around housings thanks to COVID, because we discovered that yes, housing is definitely resilient, but co-living is as well resilient. And we have fantastic numbers, much better than all the hotel industry for sure and the office industry for sure. But when you go and see an investor who's willing to do housing, okay, and you're telling him, okay, I will do housing, but with a brand new way of doing things, and I will manage it for you. You will have nothing to do with it, and you will have a good yield, a better yield than the traditional one. Then you have a good pitch. So make sure that at the very beginning, you pick the right one. Otherwise, you can lose a lot of time, because luckily everybody is now interested into co-living, but not everybody is able to do it actually, because either of the asset underlying or the yield associated or the profitability associated to this industry. And make sure in your business model that the yield you will be serving to the investor is an housing yield. Otherwise, you will be stuck into very bad deals and will lose a lot of money.
Okay, thank you very much, guys. We concluded the question that we prepared for you and we shared before. I will really thanks for your time. I will pick some question from the audience. Sorry for the guys. I start from the last one coming up. The question is around. Oh my God, it's moving. So since Ruska asked how technology is part of your value in front of an investor, or you outsource the technology. So is the technology part of your value, or investor doesn't care about that? Amaury, just because you're the last one, so please.
Well, it's part of it. Actually, every investor who is investing into colonies actually has seen at some point our technology, what we've been developing so far. So we invite them to see what we are doing, because they need to see. Okay, if you are talking about electronic signatures, if you are talking about anything digital, they will tell, okay, interesting, but you have to show them, okay, because it's when they see the place, it's exactly the same when they see what you are developing. So it is fully part of our promise, is that we want to make it simple, and in 4 clicks you are able to sign a lease and book an accommodation. So let them through it, and for sure they will sign at the end of the day.
Thank you. So your point is that the technology is a key part of your operational company.
Key.
Fantastic. And Mo, please, your point.
Sure. Yeah, I mean, it's absolutely crucial in generating demand, right? If we can showcase that through our technology engine, we've been able to create more sort of leads at the top of the funnel, and we can keep our buildings sort of constantly occupied. That really helps. And then moreover, our technology is proven to increase retention, because the technology enables the residents to self-organize, create connections, and that increases the retention in our sort of larger properties, right? When you're talking about a small co-living building, it's really easy for people to get together. But when you're talking about a large building where you might have 100 to 200 residents, right? The technology facilitates those connections. That leads to higher retention, you know, people signing second, third, fourth leases. We've been able to show that with data.
Okay, and Ritu.
Actually, let's go on to another question. Alex?
Yep, please, please, no problem.
Okay, cool. Everyone in the audience, just feel free to type in your questions. We just got one from Mandy. She said, without a property, how would you estimate the cost versus expense in order to create a realistic financial model?
Can you repeat that again? What is the question?
Yeah, I'm not sure I understand it as well. Mandy, if you're on, could you clarify? Without a property, how would you estimate the cost versus expense in order to create a realistic financial model?
All right, so so my question is, sorry, I can't get my camera. Okay, so we're operating as a nonprofit. And so we're looking for philanthropists and different things like that. But we can't give them, we don't have a property. So we don't know how to estimate what our costs would be versus, we know what our income will be because we know where our revenue is going to come from. But we don't know what would be the cost of the property. And so how would we go about doing that?
Okay, is this before you have something in hand? Is it just an exercise before you even have a property? Is that?
So we need to have, the problem is we can't get a property. We're having trouble getting a property without any kind of financial backing. So it's kind of a catch-22 for us.
The catch-22 is very a nerdy point here. Very, very good, Mandy.
I can't get a property without financing, but I can't get financing without a property.
So that's a good point.
Mentioned that, right? In some ways, it's true. I think it is a bit of an unfortunate thing where, you know, in the software world, you can actually just build something and get it out there. And of course, I mean, today you have to really think about how crowded that space is as well. But in real estate side, there is a need for, at least for if you're looking at a bigger property, then you have a need to show some financial backing behind it, just because it's still, I mean, I think the industry is still changing. I mean, it has a difficult, it's not as innovative as, you know, technology industry is or has been. So I think you have to take them to the journey, and that means that they want to make sure that you're solid. You have some backing in case something goes wrong in the operations side, that they won't necessarily lose as much. So I think, yeah, that's true. But if it's for a smaller property, you could do that, right?
So, sorry, Guy, I have to press this button. That means I prepared this for all hour. That means we have to give space to the next panel. I'm very sorry that we cannot. We do our best, me and Frank, to compress and ask all the question. And from that, we are open. Our LinkedIn is, it's available for any question for the future. I would like to thank all our guests, a real cheers and clapping, whatever. If you want to also open the microphone, no problem. Thanks, Mo. Thanks, Ritu.
Thank
thanks,
you.
Amaury. Thanks, Luca.
Yes. Yep.
And let's continue this fantastic 2 days Co-Liv Summit. Kate, are you here to take
Thank you, guys.
control of the situation?
Thank you, Alex. Bye-bye.